Ever wonder why some crypto investors always seem to win even when the market is in a downturn, while others lose it all overnight? Well, newsflash, it has nothing to do with luck. The real difference comes down to a set of key habits that most people overlook. Whether you're just starting out or have been in the game for years, here are 7 crypto investing rules smart investors live by. Ignore them at your own risk. Number 7, keep learning and adapting. The world of crypto changes faster than almost anything. New tools, apps, and technologies pop up all the time, creating both big risks and exciting opportunities. And that means if you don't keep up, you'll quickly fall behind. Smart investors know this, so they follow a routine that involves studying updates, reading white papers, and tracking trends. They also make sure to note what experts are doing and even try new apps themselves.
I've been here, like I said, 2 years, and they've been here almost the entire time. And so just listening to those other voices and opening your mind to how you can apply it in your own personal life and in your business.
But they don't jump on every shiny new trend that catches their eye. Instead, they stick to smart habits like managing risk and choosing the right amount to invest. Knowledge like that only comes from learning and adapting without forgetting the basics. Believe it or not, that's how successful crypto investors stay ahead. Number 6, ignore the hype and think like an investor. Crypto markets move fast, but hype moves even faster, and it's the number one reason new investors get burned in the game. They're lured in by flashy headlines like next 100x coin, and the fear of missing out drives impulsive decisions. But what you don't realize is that these messages are specifically written to trigger FOMO. So don't be fooled. Those chasing hype usually end up holding worthless tokens. But the pros are a different game. See, this kind of ties into our 7th point. The reason seasoned investors can ignore the hype is that they study the tech, check developer activity, follow user adoption, and ask questions. Hype comes and goes, but solid fundamentals are what build lasting value. However, the strongest lesson is yet to come. Number 5, take profits, even when it's hard. One of the biggest mistakes crypto investors make is forgetting to take profits. It's easy to get caught up in the hype, especially during bull runs. Prices keep climbing, everyone's making money, and the temptation to hold just a little longer kicks in. But what often happens? The market crashes and those unrealized profits disappear. Making money is one thing, keeping it is another. That's why smart investors plan their exits just as carefully as their entries. A great way to manage profits is to sell in stages. For example, you can sell 25% of your position when your coin doubles, another 25% if it triples, and so on. This locks in gains while still letting part of your investment grow. Another smart move is to take out your initial investment once the asset has doubled or tripled. The benefit? You're paying with profits, which reduces risk. On top of that, remember that when the market feels too good to be true, it probably is. Signs of a peak include altcoins pumping hard, inexperienced traders bragging online, and wild predictions everywhere. That's the time to cash out a significant portion, and you'll catch a hang of these things with time. However, there are some things that you need to be doing from day one when investing in crypto. Number 4, secure your assets, not your keys, not your coins. See, you need to focus on your security on top of the money. In crypto, the biggest risk isn't price drops, it's losing your assets forever. Unlike banks, there's no forgot password button here. Your private key is your only access to your crypto. Lose it, and it's gone. That's why protecting your keys is more important than chasing fast profits. The best way? Use hardware wallets, secure offline devices that keep your keys safe. While exchanges offer easier access, they also carry risks, such as hacks and shutdowns. The smartest investors use a hybrid approach, trading on reputable exchanges for liquidity, while storing long-term holdings in self-custody solutions. This strategy offers the best of both worlds: full control over your assets, enhanced security, and increased privacy compared to traditional custodial solutions. So make sure to look at your options. That said, there's something even more important than security when it comes to investing in crypto. Number 3, time in the market beats timing the market. Trying to guess the perfect time to buy or sell crypto sounds smart, but it rarely works. Most people who try to time the market end up losing money or missing out on gains. Why? Because you have to be right twice, when to sell and when to buy back in. Instead, long-term holding has proven to be much more reliable. Over the years, the market has proven that simply holding strong coins like Bitcoin or Ethereum over time delivers strong returns. A smarter approach is dollar cost averaging, aka investing a set amount regularly, no matter what the price. This method builds your portfolio over time, removes the stress of guessing market moves, and helps you stay steady through ups and downs. It's the strategy smart investors trust because it works.
Instead of investing all of your money at one period of time, you instead invest a specified amount of money on a recurring basis, perhaps weekly, averaging out your cost basis.
Number 2, diversify, but don't over-diversify. Moving on to the second investing rule. Diversification is highly recommended in the world of crypto. However, most rookie investors often fail to realize that there is a fine line between healthy diversification and counterproductive over-diversification. You see, over-diversification can lead to dilution of your profits. You're essentially holding similar types of assets that don't provide true value or diversification. So what do? Well, expert crypto investors typically focus on dedicating 60 to 80% of their portfolio to blue chip coins, aka Bitcoin and Ethereum. The rest goes to a carefully selected set of altcoins. This strategy is perfect since sticking with well-known coins that have large market caps provides some level of stability and risk management because coins with a larger market cap are less susceptible to price fluctuations. Meanwhile, investors also enjoy the freedom to explore new options. Number 1, never invest more than you can afford to lose. And finally, we have the number 1 rule for all great investors out there. Never invest more than what you can afford to lose. See, crypto is not backed by assets. The value of a coin is only determined by what other crypto investors are willing to pay. And with other factors like geopolitical events, regulatory protocols, and the economy playing a role, the crypto market is extremely volatile. There's a high chance of your investment tanking during a downturn. Though for most people, that's a deal breaker. For savvy investors, it's an invitation to step up. And the only reason they manage to do that is by managing risk and never investing a sum that could hurt them financially.
Real investors take the long view. So if you freak out, zoom out. Back up a little bit.
The benefit? When you're not exposed, you can make more rational decisions without the emotional pressure that comes from having too much at stake. It can help prevent panic selling during market downturns and impulsive buying during market euphoria, the 2 riskiest decisions that can kill investments. And that wraps up our 7 golden rules of investing. At the end of the day, investing in crypto is about following rules and being smart. Even as a rookie, you can stick to these 7 basic rules and significantly improve your financial future. Which of these rules are already part of your strategy and which ones are still a challenge? Share your thoughts in the comments. And if you're serious about leveling up your crypto game, don't forget to like, subscribe, and hit the bell so you never miss a new video.